Hello, I'm David Frazier, aka the Market Monk, and this is our daily Market Monk show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to affect your investment portfolio. So, today on Monday, June 23rd, except for Brazil's Bovespa index, which was down very modestly today, all of the other major stock market indices throughout the world were essentially unchanged today. Looking forward over the very near term, meaning over the next several days, price momentum statistics for the U.S. stock market as well as for Brazil's stock market suggest that stocks of companies that operate primarily in those countries are well, not trading, because we're currently not trading, but that they closed today on Monday, June 23rd at substantial overbought levels, and that U.S. stock prices and Brazil stock prices in general will pull back a bit over the next few days, or at least by the end of this week, but very, very modestly. I don't expect any type of major pullback. In contrast, price momentum indicators, or statistics, I guess I should say, for Japanese and Chinese stocks suggest that stock prices of companies that operate primarily in those countries have fallen to oversold levels, and that in general that Japanese and Chinese stocks will rebound over the next few days. Meanwhile, there's no clear indication from price momentum statistics of where European stocks are headed over the next few days. Meanwhile, in regard to the U.S. stock market, the New York Stock Exchange Advanced Decline Line, as well as the Chicago Board Options Exchange Volatility Index, and the percentage of stocks that have closed above their 200-day moving average were essentially unchanged today. Each of those short-term stock market indicators were essentially unchanged today. Now, even though I just finished saying that price momentum statistics suggest that U.S. stock prices in general will pull back a bit within the next few days, economic statistics for the United States have continued to be very positive and suggest that over the longer term, meaning over not only the next few weeks, but over the at least the next several months, that U.S. stock prices will continue to trend higher. For example, I think it's the Federal Reserve. I'm not sure if it's the Federal Reserve or the I'm not sure which agency. It might even be the U.S. government, the U.S. Department of Commerce. But regardless, a major economic statistical agency reported today that sales of previously owned homes in the United States rose during May for the second consecutive month. And that doesn't surprise me at all. You know, I told you early last week, that my research indicated that contrary to what Wall Street economists were expecting, that the housing market here in the United States would continue to improve during the months ahead. And the reason that I came to that conclusion was that, you know, as I've said many times in this show, I pay most of my attention to reliable leading economic indicators as opposed to coincident or lagging indicators. And even though the construction of new homes, which is a leading indicator, as well as the building permits issued to construct new homes, were down a bit last month, but very, very modestly. Other leading indicators for the housing market continue to suggest that home sales here and the housing would move up during May, that they had moved up during May, and that the housing market will continue to improve during the months ahead. Nothing has changed. That continues to be the case. Regarding some other statistics that were issued today regarding economic developments in other parts of the world, Market Economics, which is a leading economic research and forecasting firm, reported this morning that manufacturing activity in the Eurozone rose this month during June for the 12th consecutive month. And Marquette also reported that manufacturing activity in Japan and China also increased this month after declining during the past few months. Specifically, manufacturing activity had declined in Japan during March and April, and had declined for 5 consecutive months leading up to this month in China. So we were seeing somewhat of an indication of a slowdown in Japan and China's economy. Now, 1 month of rebound in economic activity in the manufacturing sector, is not something that I would give a lot of weight to. I like to see at least 2 or 3 months of increases in leading economic indicators such as manufacturing indices. However, regardless of that, it is a positive development that, at least according to Market Economics, that manufacturing activity in Japan and China did rebound this month. And the manufacturing activity in the Eurozone was up for the 12th consecutive month this month. Now, looking forward, several very significant economic statistics for the United States are scheduled for release later this week, with the U.S. Department of Commerce scheduled to announce tomorrow morning on Tuesday, June 24th, the number of newly constructed homes that were sold during May. And then on Thursday, the Department of Commerce is scheduled to announce the amount of orders for durable goods from manufacturers of those goods for the month of May. And then on Thursday, I'm not sure which reporting agency, but we have statistics regarding personal and household consumption expenditures for the month of May. And lastly, on Friday of this week, the University of Michigan is scheduled to release its Consumer Expectations Index, which is based on hundreds of surveys of phone calls to U.S. households throughout the country and asking persons that live in those households what their economic expectations are for the next 6 months. And that's a very reliable leading economic indicator. Let's see, what else do I want to talk about today? Tonight's supposed to be our show that focuses not only on the daily significant economic announcements, geopolitical developments, and just activity in financial markets around the globe, but in addition to that, which we do every day of the week, on Mondays of every week, I get in a little bit more detail regarding not just daily factors and economic announcements, but other recent factors and developments, and talk a little bit about what my analysis of various factors and developments suggests regarding not only the near term but the longer term. And for me, by the longer term, I mean up to 18 months, 12 to 18 months into the future. I generally don't talk about 10 to 20 years into the future. That's something that a lot of so-called financial advisors like to do. I say so-called financial advisors. Most of those advisors, at least the ones that are employed by brokerage firms, don't get paid and are never judged by their financial advice. They get paid according to how much money they bring into their firms. But let's not get off track here. those folks and many other so-called financial experts and pundits and stock market strategists and mutual fund portfolio managers often talk about the long term in terms of 10 or 20 years out into the future. Well, you know what? I don't have a clue as to what's going to happen 10 or 20 years from now. And guess what? Those guys don't either. They have no clue in the world. So instead of talking about what might happen 10 or 20 years from now and trying to give advice to you, our listeners and subscribers to our financial market newsletters regarding where prices of stocks, bonds, precious metals, commodities are headed going forward, I stick to what I've been able to do well in the past, and that is to look out approximately 12 to 18 months into the future. I've been very good at that over the past 15 years. So that's, when I talk about the long term, I'm talking about at most up to about 18 months into the future, and generally I'm speaking of several months into the future, not 10 or 20 years from now. Now, having said that, one of the in addition to sort of a continuation of very positive readings on leading economic statistics that have been issued pretty consistently over the past few months, suggesting for several months now that the pace of economic growth here in the United States, as well as in many other regions of the world, will increase during the second half of this year, and pretty substantially here in the United States, according to those leading indicators. We got another important announcement from the Federal Reserve last Wednesday to be exact, regarding the Federal Reserve's open market committees. That is the committee that determines the Fed's monetary policy and what they're going to do to try to affect short-term and longer-term interest rates. We got another important announcement from the Fed, and even though it was no different than what they've told us for, oh my gosh, at least 6 months in a row now, if not 9 months, it was still an important announcement, and that is the Fed told us last week that it plans to continue to purchase huge quantities of U.S. government securities as well as mortgage-backed securities in an effort to keep lending rates here in the United States at very low levels. Now, although the Fed said last Wednesday that beginning on July 1st that it plans to reduce its purchases of both mortgage-backed securities and longer-term Treasury securities by $5 billion per month, it also stated that it plans to continue to purchase large quantities of those securities. And specifically, the Fed said that in its view, a highly accommodative stance of monetary policy remains appropriate. The Fed went on to say, quote, that it will continue its purchases of Treasury and agency mortgage-backed securities and employ its other policy tools as appropriate until the outlook for the labor market has improved substantially. The Fed added that it continues to anticipate that it will maintain the current target range for the federal funds rate, that's the interest rate at which commercial banks lend to each other on an overnight basis, that it will continue to keep that short-term, very short-term interest rate at a very low level for a considerable amount of time after its asset purchase program ends. And lastly, the Fed stated, quote, that it anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may, for some time, warrant keeping the target federal funds rate below levels that the committee views as normal in the longer run. So, that might have bored you a bit, but it's very, very important to read specifically what the Fed says that it plans to do. And by reading those comments from the Fed, it's very clear that even though I expect, based on my research, for lending rates here in the United States to rise during the second half of this year, I expect those rates, whether it's very short-term rates or very long-term rates, such as the 30-year mortgage rate, to rise very modestly. And the fact that the Fed is making these types of statements that it's going to essentially do everything that it can to maintain lending rates at very low levels, well, that's a very, very positive factor that is likely going to continue to positively affect stock prices for many months into the future, at least through the end of this year at the minimum. So, we got a lot of positive developments going on here. I've been saying this for months now, and I've been telling readers and subscribers to our financial market newsletters for many months now that they and you should ignore these fear mongers that are always saying something somewhere, either on broadcast TV shows or in publications, to ignore those folks and to I'm not saying that you shouldn't pay attention to negative factors and developments, as I always do, but I and you should pay most of your attention to statistics overall and economic indicators overall, not just a few that might be negative or a few that might be positive. Well, what does a big group of those statistics indicate on average? And I can assure you, as a result of monitoring hundreds of economic statistics around the globe every month, that indications from leading economic statistics have continued to be very positive, and therefore that stock prices, at least here in the United States, are very likely to continue to trend higher over at least the next several months, and really longer than that, in my opinion, well into the first half of next year. So that's all that I have to say today. I don't want to get unnecessarily long-winded. Tomorrow on Tuesday, I'll discuss in a little bit more detail some significant recent developments in other parts of the world, and then on Wednesday of this coming Wednesday, as on every Wednesday night, I'll discuss some stocks that I'm monitoring that seem to be poised for some substantial gains during the months ahead. So I thank you for listening, and I'll speak with you again tomorrow.